A president is trying to fire a Fed governor. Again. If that push succeeds, the central bank that sets borrowing costs for every American mortgage, car loan, and credit card could answer to the White House. Can a president actually take over the Fed? And what happens to your wallet if he does? President Donald Trump has resumed his effort to remove Federal Reserve Governor Lisa Cook, his second attempt after the Supreme Court blocked the first. The stated goal is to fill the Fed's board with officials more aligned with the White House. The Fed's benchmark rate stood at 3.63% as of early July, and inflation was running at 3.5% year over year as of June. Those numbers sit at the center of a quiet but consequential power struggle, and the answer to how dangerous that struggle really is depends entirely on understanding one mechanism, the one that makes central bank independence worth fighting over in the first place. The Federal Reserve is the United States central bank. Its core job is to set the short-term interest rate, the price that banks charge each other to borrow money overnight. That one number ripples outward into every corner of the economy. When the Fed raises it, borrowing gets more expensive everywhere. Mortgages, car loans, business credit lines. When it cuts, borrowing loosens up. The Fed also controls the money supply, acts as a lender of last resort when banks get into trouble, and supervises large financial institutions. It does all of this, in theory, without taking orders from the President or Congress. That independence is not an accident. It was built deliberately because the people who designed modern central banking had seen what happens when politicians control the money printer. They had watched governments inflate their way out of debt by simply creating new currency, wiping out the savings of ordinary people in the process. Independence was the solution. The idea is straightforward. A committee of experts, shielded from electoral pressure, can make the unpopular call, raising rates, slowing the economy, accepting short-term pain that a politician facing re-election never would. The president appoints Fed governors and the chair, but once confirmed by the Senate, those officials are supposed to be removable only for cause, not for disagreement, not for inconvenience, for genuine misconduct. That legal wall is exactly what is being tested right now. Think of the Fed as a referee in a professional sports league. The team owners, the elected government, set the rules of the game and hire the referee. But once the whistle blows, the referee calls fouls on everyone, including the team that hired them. The whole system works because fans, players, and broadcasters trust that the referee is not on anyone's payroll during the match. The moment people believe the referee is throwing calls for the home team, the game loses its meaning. Markets work exactly the same way. Bond investors, pension funds, foreign central banks, they all hold dollars and dollar-denominated debt because they believe the Fed will fight inflation even when it hurts. That belief is the foundation. It is what keeps long-term interest rates anchored. When that belief wobbles, investors demand a higher reward for holding long-term debt because they are no longer sure the referee will make the hard call. And here is the thing about referees. Their authority is almost entirely psychological. A referee with no credibility is just a person in a striped shirt blowing a whistle. A central bank that is seen as the president's instrument is just a printing press with a marble lobby. The 10-year Treasury yield, the rate the government pays to borrow for a decade, stood at 4.69% as of early August. That yield reflects what markets think inflation will average over 10 years. It is, in a very real sense, a live poll on whether people trust the referee. Anything that makes the Fed look less independent tends to push that number up. And when that number goes up, the cost of long-term borrowing goes up with it, for the government, for businesses, and for anyone with a fixed-rate mortgage being written today. Here is where this leaves the kitchen table. A 30-year mortgage rate does not live in the Fed's overnight rate alone. It lives in the 10-year Treasury yield plus a spread. When investors get nervous about the Fed's independence, they push that yield higher, and the spread that mortgage lenders add on top tends to widen too. The result is a higher monthly payment on the same house. Not because inflation changed, not because the economy overheated, but because the referee looked like he was about to get fired for calling too many fouls on the home team. The same logic runs through car loans, small business credit, and the financing costs of companies whose goods sit on store shelves. Higher financing costs for a retailer mean tighter margins, which eventually mean higher prices or fewer products. The person standing in the checkout line never sees the Federal Reserve, but they feel it every time the packaging gets smaller or the sale price disappears. Unemployment sat at 4.1% as of early July, a relatively stable labor market. But monetary credibility shocks rarely show up first in jobs data. They show up first in bond markets, then in lending rates, and only later, if the shock is sustained, in hiring decisions. The sequence matters. By the time most people notice something changed, the mechanism has already been running for months. So back to the question from the top. Can a president actually take over the Fed? And what does it cost if he does? The legal answer is genuinely unsettled. The law says governors can be removed only for cause. Courts have historically protected that principle. But historically is doing a lot of work in that sentence. This is a boundary that has rarely been pushed this hard, and the Supreme Court has already weighed in once without fully resolving it. The economic answer is cleaner. Central bank independence works exactly like a referee's credibility. It is not a physical thing. It is a shared belief. You cannot see it on a balance sheet. You feel it in the rate you are quoted on a loan. Even the perception that the Fed might take political instruction is enough to move bond markets, because investors do not wait for proof. They reprice risk the moment doubt enters the room. History offers a consistent lesson here. Countries that have lost central bank independence to political pressure do not lose it with a bang. They lose it gradually, through appointments, through pressure, through the slow replacement of referees who call it straight with referees who know which team pays their salary. Whether this specific attempt succeeds or fails, the mechanism it is prodding is the same one that has driven inflation crises, currency collapses, and lost decades in other economies. That mechanism does not care about politics. It only cares whether people believe the referee is independent. And right now, that belief is being tested in public, in real time, with real money on the line. If you found this useful, share it with someone carrying a mortgage or a car payment. They have more skin in this game than they know. Subscribe to Investors Club Global for more explainers on the mechanisms that move your money.